AC 305, Cash and Cash Equivalents, Section 2 of 6, Classification, the 3 categories and 3 tests. Okay, let's jump right in. In our previous explainer, we laid down the core definitions of cash. Now, we're establishing the absolute ground rules for classifying it. If you deal with balance sheets, you know accurate classification is literally the bedrock of financial reporting. So we're going to unpack exactly how to categorize every single dollar or potential dollar your organization holds. Here's our roadmap. We are moving from the foundational 3 buckets straight through to a foolproof 4-step decision framework you can print out and use right at your desk. Starting with our highest stakes principle, the absolute rule: no balance left behind.
So the crucial takeaway here is that every bank account, every investment fund, every bit of petty cash you hold must be classified into one of 3 distinct buckets without exception. There is 0 ambiguous gray area allowed on the balance sheet. This classification is vital because it completely dictates your balance sheet line items, your cash flow statement, and all of your disclosures. You simply cannot leave a balance floating out there unassigned. It has to go somewhere.
Let's look at Category 1, unrestricted cash, immediate and fully accessible. What's really interesting is that unrestricted cash is way more than just a checking account. Sure, it includes your standard bank demand deposits, like a payroll account you can tap into without notice or penalty. But it also includes currency on hand. Think physical petty cash coins in the office safe. And critically, it includes undeposited funds. If you've got customer checks literally sitting in an in tray at 5 p.m. waiting for tomorrow's bank run, that is unrestricted cash. It's money the company has immediate full access to. Moving on to Category 2, cash equivalents, and the 3 strict tests. Cash equivalents are short-term investments that are so incredibly liquid and stable, they act basically just like cash. But to earn this label, an instrument has to survive a rigorous gauntlet. Specifically, it must pass all 3 of these sequential tests. Test 1, an original maturity of 3 months or less. Test 2, it has to be readily convertible to a known, fixed amount of cash, meaning you know exactly what you're getting when you cash it in. And Test 3, an insignificant risk of change in value. Failing even a single one of these completely disqualifies the instrument. Now, pay close attention, because this right here is the biggest trop in the entire standard. When applying Test 1, notice the word original in original maturity. We strictly look at the maturity measured at the exact date of purchase. We do not care about the remaining maturity, meaning how much time is left on the clock at the reporting date. If you buy an instrument that had a 6-month lifespan the day you bought it, it will never be a cash equivalent, period, even if it only has 2 weeks left until it matures right now. Let me repeat this because it's where folks always trip up. All 3 tests must be satisfied. 2 out of 3 is not enough. If an investment hits the maturity date perfectly, and you know the amount, but it misses the 3rd test, like, say, an equity security that constantly fluctuates in value, it gets completely bumped out of cash equivalents and lands on a short-term investment line. And that brings us to Category 3, restricted cash, locked up and set aside. This bucket covers funds the company legally or contractually cannot use for general operations. Think about a loan compensating balance where your lender forces you to keep a minimum amount sitting in the bank, or an escrow account, or cash pledge as collateral. We care so much about this because combining restricted cash with unrestricted cash artificially overstates your available liquidity. You're basically telling investors you have money to spend when legally your hands are tied, so they have to be separated. But here is a massive warning sign. A super common mistake is setting the classification for restricted cash once and then just forgetting about it. You must reassess whether that restriction is current or non-current at every single balance sheet date. As a release dates approach, a non-current restricted escrow balance from last year's report might lift within the next 12 months, which means it becomes a current balance this year. Always check the clock. Let's tie all of this together with the 4-question framework, your desktop decision matrix. Okay, this is an incredibly practical tool. You ask these 4 questions in sequence for any item on your ledger, and you stop at the very first one that gives you a clear yes. Question 1, is it available for immediate unrestricted use? If yes, it's cash. If no, move to 2. Does it pass the 3 sequential tests we just covered? If yes, cash equivalent. If no, move to 3. Is there a legal or contractual restriction? Yes, restricted cash. And finally, 4, is the bank balance negative? If yes, it's a bank overdraft. Stop at the first yes, and boom, you have your precise GAAP classification. Let's put this framework to the test with some real-world classification examples. So how about a common scenario? how would you classify a money market fund that you can tap into daily and it maintains a $1 net asset value? Think it through the framework. The answer is a cash equivalent. It passes the maturity and liquidity tests easily, but the magic here is that stable $1 NAV. Because the value stays perfectly stable at exactly $1, it sails right through our strict third test, an insignificant risk of change in value. It behaves just like a physical dollar bill. All right, here's a classic trick question. You're holding a certificate of deposit, a CD. It has only 2 months remaining before maturity right now at your reporting date, but it was originally a 6-month CD when you bought it 4 months ago. So, is it a cash equivalent? It fails test 1. Why? Because we measure from the purchase date. Since the original maturity was 6 months, which is clearly greater than 3 months, it fails the very first test immediately. And remember, 2 out of 3 is not enough. Therefore, it's a short-term investment, not a cash equivalent. Consider this matrix your ultimate cheat sheet. It cleanly resolves a whole variety of instruments based strictly on our framework. A 90-day T-bill, cash equivalent because it passes all 3 tests. But a 5-year government bond? That's just an investment because the original maturity far exceeds 3 months. Or think about equity shares in another company. They fail test 3 because their value fluctuates, making them an equity investment. If you consistently follow the framework, the math just does itself. Let's look at one final twist, an account that has been overdrawn. Say you have a negative $10,000 bank balance. Do you just subtract that from your overall total cash? Actually, scratch that, you cannot present negative cash on the balance sheet. A bank overdraft is classified as a current liability. The only exception, and this is a remarkably strict one, is if you have a formally documented legal right of offset with another positive account at that exact same bank. Without that formal legal documentation, that negative 10 grand sits firmly in your liabilities. Well, I hope this explainer gives you the exact tools you need to confidently tackle any classification challenge that lands on your desk. In our next explainer, we're going to drill much deeper into restricted cash, recognition, and measurement. Until then, I'll leave you with this thought for your next reporting period. Have you strictly applied the 3 tests in the 4-question framework to every single balance on your ledger? Or are you letting some of those hidden original maturities slip through the cracks? Thanks for diving into the details with me.